We mentioned the historic plunge in GDP for Q2, a little bit better than estimates had been looking for. Joining us this morning with the first reaction from the White House is a familiar face to a lot of CNBC viewers, chief economist at the National Economic Council now, Joe Livornia. Joe, welcome. Good to see you again, and congratulations on the gig.
Thank you very much, Carl. Thank you.
It's a heck of a time to come in, obviously, given the data today. How does the White House want investors to think about this GDP number?
First of all, Carl, the figures are annualized, which is fine when you have a growing economy, which happens about 95% of the time. So if you look at it, it's really more like a 9% drop, 9.5% drop, because we annualize it, assuming it's going to continue for the full year. That's clearly not going to happen because this really is a pandemic contraction, and we've seen it in the data with March and April being extraordinarily weak and then seeing record growth in many series in May and June: retail sales, industrial production, employment, the PMIs, the purchasing manager indices. So we're looking at this as really being a shock, almost something akin to a natural disaster. And the road to recovery, the building blocks are there, and we expect a much stronger third quarter and second half of the year.
In terms of the more high-frequency numbers then, Joe, gasoline demand, card spending, open table, all the mobility, all these numbers there. And even Powell yesterday suggested that maybe the pace of recovery turns more from a V to a Y, let's say. Is that fair in your view?
No, I don't, because the thing is you have to put the context of the May and June, even July data. I mean, you talk about some of the figures. The mobility numbers are actually edged up back to a new high. But the PMIs, the regional Philadelphia, Richmond, and New York Fed surveys had great July results with expectations. This is important, Carl. Expectations of future order flow and employment reaching new highs. So some of the data is more mixed, but we're looking at that more as being a factor after record growth in May and June. I mean, you're going to have a pullback, and that needs to be put in context of the expectations of what people thought that data was going to look like. So we're on the right path. We're certainly going to see some weakness here and there. Nothing moves in a straight line, even in V-shaped recoveries, but the numbers look really good.
Hey, Joe, it's David. This would be a typical question I might ask you when we were on set at the New York Stock Exchange in your old gig, but I'll ask it anyway. It seems somewhat counterintuitive given what we're talking about in the economy, but do you have any concern about inflation overall? And what do you make of the move in gold and the debasing of the currency that we see going on in terms of at least the dollar weakening substantially, given all that money that we're printing?
Sure. I mean, I love looking at commodity prices, but I prefer more the industrial metals. And the move in copper has been pretty incredible. And that suggests, David, that there's a real surge in industrial demand. I mean, one of the things that should be highlighted in today's GDP report is this is an amazing statistic, over a $300 billion drawdown in inventories. That alone took 4 percentage points off of GDP. So we're seeing commodity prices accelerate, in part because of industrial demand. Related to gold and the dollar, that to me just reflects the fact that the Fed needs to keep monetary accommodation still in place. The dollar is still very strong. I don't worry about inflation. We're not worried about inflation in the short term. Central banks around the world aren't worried about inflation short term. The Treasury market is pricing in a little bit more inflation, but still well below the Fed's target. So I don't look at what we're seeing in the FX and commodity markets as being anything different than what we're projecting for the broader U.S. economy.
So, Joe, you have the monetary inputs look like they're where you'd want them to be, as you said. Maybe an industrial comeback, certainly globally, weak dollar. So a lot of the ingredients, however, a lot of fixation on the fiscal side of things and what needs to be done right there. Obviously, negotiations underway, but
Sure.
How crucial is it? What are your expectations? What's the state of play in terms of the White House priorities in things like, enhanced unemployment benefits?
So right now, we're at a standstill, as you know. The president wants a quick and temporary extension of the federal unemployment insurance, that plus up. Also, we want to extend the moratorium on evictions. We'd also like to, give credits to businesses that retain workers, and also give some sort of credit to people who are incentivized to go back to work. So we're hopeful those things will get done, and we'll see what happens.
Finally, Joe, on the tape this morning, a headline about China, biggest import deal ever for corn, 1.9 million tons. How are we processing the relationship when we need them to catch up on their phase one commitments, but the Secretary of State is is calling their kind of communism a virulent strain.
Yeah, well, I'm focused right now, Carl, on the data, and for what it's worth in the GDP figures, the one series that didn't move a whole lot was the trade deficit. So I'll leave it there.
Finally, Joe, part of your job is going to involve paying attention to and reacting somehow to the president tweeting about whether or not we should delay the election, how drug prices and drug companies need to be looked at with suspicion. How are you going to do that?
I mean, I'm looking at the financial markets, and the markets are telling me, when I look at equities, and we talked about what's happening with commodity prices, I mean, the markets is telling you that the outlook for growth is very good. And if we're talking about a 20% second half recovery and then a 5% type of growth rate early next year, we'll be back. We'll have recouped all the lost output. To me, that's what matters most are the policies. And it seems to me a very pro-growth, the regulatory backdrop where you incentivize risk-taking through pro-growth supply-side tax cuts. That's what really investors are focused on, and that's what really matters. And my role is to focus on the economy and to tell people what the markets are saying. And to me, what I see looks really good, and that's where my focus is and will continue to be.
Well, as you know, Joe, communication to the market has never been more important than now, given the uncertainties. We look forward to talking to you as often as possible. Thanks.
Thank you, guys. Good talking to you.